My guest today is Kashyap Chanchani. Kashyap is the managing partner of the Rainmaker Group, where they work with both traditional family businesses and venture capital-backed companies in India. Today, we are focusing more towards traditional businesses. So thanks a lot for coming to the Holdco Builders show, Kashyap.
Thank you so much for inviting me, Mick, and look forward to our discussion over the next 1 hour.
Awesome. Before we get started, can you share a little bit about your background and life before the Rainmaker Group?
Absolutely. So I started the Rainmaker Group, which is among India's premier investment bank when it comes to advising companies on private placement, fundraising. So what we do, Mick, is advise companies in India, both traditional family-owned businesses as well as venture-backed businesses that are started by first-generation founders when they want to raise capital, and we advise private companies. Before I started the Rainmaker Group, I was essentially just sleepwalking through life, right? Running, doing random jobs, including various investment banking jobs, and it was some of my founders, some of the businesses that I used to work very, very closely with, who kind of encouraged me to start out on my own. So still very, very grateful to them for that.
You mentioned the sleepwalking through life. I like this saying. I'm sure I've heard this before. Can you talk more about this period and how did you come up to a realization that I should do probably something more serious because I don't want to be my whole life to be me sleepwalking through it?
No, absolutely, Mick, would love to. So, essentially, I'm an engineer. I learned electronics and communication engineering, back in my tech school. And after that, I did an MBA from one of the better business schools here in India. And till the time I turned 30, I'd pretty much done everything. I had done, coding for large companies like GE. I had done corporate strategy. I had sold consumer products. So the first consumer products for whom I was a product manager was selling pillows, right? I had worked in commercial banks. I had done a bunch of work, and as a young professional, one of the things that I really wanted to do was general management, something that kind of involved a little bit of everybody. And as I grew older, I realized that investment banking was the perfect general management job. You need to understand law, you need to understand finance, you need to understand sales, you need to understand strategy, and you need to have a lot of empathy with people that you're working towards. And when we started cracking some of our better deals is when I kind of started finding my mojo, and I realized that this is what I want to do. I want to be an investment banking entrepreneur and do nothing else for the rest of my life.
Beautiful. I've been in India myself. It was 4 or 5 years ago, Indian wedding, and I was fortunate enough to spend there almost 2.5 weeks. It's a very different place compared to Estonia or Switzerland, where I've been some time. And surprisingly, you can get a lot done when you speak English. At least that was the case in New Delhi. So my question, I want to put you in a spotlight. Should one maybe come to India, raise the capital, and start building their own? Is it a private equity fund or a holding company of traditional Indian businesses? And what is your thoughts about this?
No, absolutely. So, Mick, in the last 10, 15, 20 years or so, the first generation Indian entrepreneur, who's raised money from VC, they are the kind of people who've been in the spotlight. There's been a lot of conversation around India being among the top 3 or 4 venture capital markets in the world, and how we've got 24 businesses now which are venture backed and now listed, and some of these founders, for absolutely the right reasons, are very highly celebrated. But in this celebration and typecasting of India, what we forget is that at the heart of Indian business lies the family run businesses. And I'll give you some very, very interesting stats. So India is among the most mature, so to say, capital markets in the world. our market cap would be close to $5 trillion. I think the only stock exchanges that would be larger than us in the world would either be in Japan, or it would be Euronext, or Nasdaq, or NYSE, and Shanghai. Apart from that, there wouldn't be any other stock exchange in the world which is larger than us. Now, almost 60% of our 50 largest companies, so it's called the Nifty 50, the most important and consequential companies in India are called the Nifty 50. 30 of these companies are family run businesses, and they account for more than 50% of India's market cap. So that's how important family run businesses are really to India's economy. And within this bunch, if I take the four largest business groups in India, right, the Tatas, the Ambanis, the Adanis, and Bajaj, they would account for more than $1 trillion in market cap. So, which is 20% of India's market cap. So this is how consequential traditional and family run businesses are to the wider economy. And, when it comes to being open to external pools of capital, the other day before, our conversation, while I was doing some research, I figured out that 30% of the family run businesses in India are open to and attracted to raising private equity funding, which is almost twice of the global average. Even to me, these stats were quite stunning around, how important family run businesses are, to the core of Indian economy, and how open they are, to the modern ways of doing business and, the modern financial sources that we have at our disposal today that in India we probably didn't have, say till about 15 or 20 years ago.
So based on your experience, yes, those companies are open for additional capital. Do they prefer outside investors or they prefer Indian capital? How important is this for them?
No, that's a very, very interesting question, Mick. And, let me break it into a few nuances. The typical journey, I mean, if I have to say, if I have to share a typical journey of a family run business in India when it comes to raising funds, see, their first choice of capital has been debt. They would typically go to a bank or a non-banking financial company and try and raise debt to the extent that they can grow. And only when they realize that they're not able to get enough capital, for capex or for working capital or for increasing their marketing spends, is typically when they go out to raise money and dilute equity to private equity funds or venture capital funds, or hit the capital markets. So traditionally this is how the journey has been. Now, within the pool of, say, private equity players, I think more than just the valuations, more than just the check size, more than their ability to add value, I think comfort matters most. Comfort around, who are the people that I'm dealing with. They are a lot more important than the brand of the private equity institution that is, coming to potentially back them. And here is where I see a big difference between family run businesses and those that are run by first generation founders. First generation founders are typically a lot more transactional, right? They're a lot more open to risk. So given a choice, they would optimize a lot more for brand and valuation, whereas family run businesses would value relationship and comfort with the counterparty a lot more over other tangible variables.
So a little bit about the succession. So when you talk to those businesses, on average, on which generation they are? Is it first generation, second, third, fifth? India has a long history, so how has it been?
So typically it's the second generation. So I would say 4 out of 5 cases would be the second generation that typically goes out to raise external money and seek external monetization solutions.
And what about the succession when it comes to the gap between first and second or third generation? For example, in Estonia, I see, and in Baltics, we see that the kids are oftentimes not interested when it comes to their father's very traditional manufacturing company, for example. How is it in India? Do people, for example, son of a business owner, he would like to keep running the family business, or he would be maybe more interested in selling the company and maybe getting into more attractive space like building a startup, for example?
That's a very interesting question, Mick, because here in India, the how the succession planning pans out is very, very different from US or Europe. My understanding of how it pans out in Europe or US is very, very similar to yours. In India, typically the problem is very, very different. The problem is that, listen, what you're doing as my father or as my mother from whom I'm inheriting the business is not enough. So for instance, recently we advised a company where, the first generation used to be in the business of textile trading. Now the next generation, when it took over, it took the business to branded clothes, right? Setting up a brand, which is very, very prominent in India as well as abroad. So the challenge for the next generation comes from uh, you know, them not inheriting a business which is interesting enough. And typically, the path they end up taking is that, listen, let me take this business in a completely new direction rather than, trying to find a solution where I'm selling the business to an external party and taking all the money and starting something afresh. Because, see, in India, again, families tend to be very, very large and families tend to be very, very close. So, and the other factor is that monetization solutions are not very, very easy. So in the US, if I own a business which generates say about $1 million of EBITDA on about say $10 million of turnover, right? There are tons of financing solutions, right? There'll be a bunch of guys who can roll me up into a holdco. Now, those solutions are few and far by to come in India, especially for small and mid-sized businesses. When it comes to large businesses, of course, there are enough and more domestic and global private equity players who'd be more than happy to buy them out. But when it comes to some of these small businesses, I don't think our markets are just as deep as yet. The other thing is that given that these families tend to be very, very emotionally attached to their business and they are very, very close as family, kids typically tend to take an approach of, listen, I've inherited something from my father. How can I make it better? How can I make it more modern? How can I make it more valuable by taking it in a direction which is very, very different, but building on what has been given to me rather than sort of say sell the company and start something completely afresh. So this is the cultural context in which Indian family-run businesses are very, very different from what you'd see in the West.
When it comes to the companies you have the experience with, how much are those businesses looking towards exporting their products and services versus just focusing on the Indian market and being happy doing this, because I mean it's a huge market. I mean Estonia have just 1.3 million people. I'm sure India has like 1.3 billion people, so it's a totally different league. So
Yeah. So, again, very, very interesting question, Mick. In fact, it's the other way around. If you look at family run businesses or businesses at large in India till about 10, 15 years back, their focus was on exports. So, you'd see that the first generation of Indian technology companies as well, Tata Consultancy Services, Infosys, Wipro, the first generation of, I'd say the first wave of entrepreneurship, formalized entrepreneurship in India was focused towards export of services. Okay. Now, given that our markets, our domestic market in terms of consumption, in terms of depth, have been doing better over the last 2 decades, increasingly we are seeing focus more on the domestic market as compared to exports. There'll be like dozens of examples of children, of some of these business families who would have gone abroad for their higher studies and would have been professionals abroad, them coming back and taking over the family business because the domestic market itself is becoming so exciting. They would have worked at a Goldman Sachs, they would have worked at a McKinsey. They're all reading and hearing about the sort of say the change that's happening here in India, and they realize that given their family legacy, they've got a bigger chance of wealth creation coming back here to India with whatever they've learned, rather than just being a professional earning a couple of $1 million a year, in the West.
So a little bit about the financing, again, based on your experience and what you see, how do those traditional businesses generally approach financing and capital raising, and maybe how much debt are they willing to use to expand and grow?
Okay. So, Mick, if I look at the landscape for family run businesses to raise money today, I think I mean, when it comes to mid sized or large businesses, it is probably just as good or bad as anywhere else in the world. So, some of the largest private equity or venture capital funds in the world, right? Say a Blackstone, a KKR, an Axel, a former Sequoia, they would all have outposts here in India with fairly large funds which are earmarked for investing in India. So the private equity market is reasonably deep for high quality businesses. Number two, the capital markets themselves, the IPO markets are again reasonably deep. So, India, we're probably a developing economy, but when it comes to our financial institutions, we are just about the best in the world. When it comes to our central bank, the Reserve Bank of India, when it comes to our capital markets regulator, the SEBI, right? And our financial infrastructure. I mean, we've got T+1 settlement, we've got digital payments, which are first world in nature. So, in many ways, India is a third world country moving towards a second world country. But our digital infrastructure and financial infrastructure is very, very first world in nature. So, for companies that have very, very good corporate governance, I think the capital markets again are very, very, very rewarding. So the typical journey, I would say, begins with a family-run business being self-financed to the extent that they are able to create a long enough track record that they are able to raise money from banks and other debt institutions, right? Over a period of time, once they build credit history, their cost of capital goes down. But if their ambitions go up from then on, till about 10, 15 years back or so, most of them would hit the capital markets directly. Now they want to take a pit stop because, private equity funds the world over, including India, comes with their own best practices in terms of, how they can help the business do better. B, also they add a layer of credibility to these companies before a listing event and then they list. So, this is the typical life cycle that we end up seeing here in India.
How much do you see that it could be a big player or just professionals who have all the investment banking experience, for example, and they would like to build something serious like you did with the Rainmaker Group, and they don't want to sleepwalk through life, so they come up to an idea that, okay, let's build a holding company and let's start acquiring small businesses. How much do you see that they go outside, they raise some, I mean, going outside, I mean, raising capital from Indians, then they have a bit of their own savings, and then they put it all together and they start buying those tiny small businesses. How much do you see that?
That's a very good question, Mick. So, this is one part of the market which is not particularly developed in this part of the world, right? Now, there are two or three reasons for it. One of them is that small businesses, businesses, when I say small businesses, I mean businesses which would typically have, say, a profit margin of, about $1 million to $2 million. Their revenue would be, say, anywhere between 10 million to 20 odd million dollars. They are not very, very well institutionalized. They have huge dependence on, the owner manager. So, that's one problem. The other is that, we are a very, very high context society. People's attachment to their business, tends to be very, very, very high. So, when you talk about raising, say, external capital for growth, divesting minority, I would say, Indian businesses are very, very open. They are very, very prepared. But the next level of institutionalization that is needed, that listen, I mean, if I don't wake up tomorrow morning, my business will probably still run to the extent of 80% of how it was running, as compared to when I was around. I don't think our small businesses have achieved that level of professionalism and maturity. And number two, that entire cultural mindset around, listen, I don't want to sell the company is still reasonably prevalent, which is the reason why I so wish and pray that, holdco kind of structures were really successful in this kind of market. They are not particularly successful. Uh, these work very, very well when, say a large private equity fund or a large sovereign fund, okay, puts together a vehicle and, which is trying to acquire companies, which has got revenues and EBITDA in, say, few, hundreds of millions of dollars. So when it comes to large businesses, the holdco structure works very, very well. When it comes to smaller businesses, I don't think, um, as a country, we've institutionalized our small businesses to the extent that we can see this kind of monetization.
Now, a little bit about the business owners. How do you see that? You mentioned folks saying that I don't want to sell the company. So, how common it is in India that the guy turns 50 or 60 and is like, okay, I've been doing a lot of work. It's time to retire, spend more time with family and kids, versus they're like, I don't want to sell a business. What else am I going to do? Because the second is probably true in when we take Estonia and Scandinavia overall. People are willing to work for old age. So how is it in India?
Yeah. So, see, I think in India, we probably see outcomes that are a lot more binary in nature. So I would say there'll be a lot of businesses which will, where, let's say, the patriarch or the matriarch who's running the business, as they're getting older, some of these businesses will slowly, start winding down and die a natural death, right? While the owners have made money from, the operating cash flow of the business. And in other cases, the second or third generation would have taken over the reins, and those businesses would have probably moved, to an orbit that is, 10 times or 20 times higher than, when the patriarch or matriarch started. I don't think in my professional life, has seen too many outcomes that are, very, very middle of the road business as usual kind of outcomes. So I would say they are very, very, binary in nature.
But still, there are probably a lot of deal making going on. So when talking about this, what are the most attractive opportunities, industries, niches that investors and could be private equity investors looking at? In Europe, there is a big trend, and in Europe and in US, putting together all the SaaS companies or HVAC companies. How is it in India?
Uh, no, great question again, Mick. So, incidentally, the largest private equity deal which is happening in India right now at about $8.5 billion is a deal where, Blackstone is supposedly buying the largest homegrown family-run snacking brand in the country, right? So
Snacking?
right from
Snacking?
snacking, yeah,
Okay.
savory snacks,
Mhm.
right? On one hand, you will see family-run businesses that have built very large or very enduring um, consumer brands over the last 10, 15, 20 years. Uh, that's one area where, you will see some very, very scaled outcomes, but majority of the mid-sized family-run businesses would probably be in more traditional industries like manufacturing. So, some sort of manufacturing, some sort of trading would probably be the mainstay of family run businesses in India. But apart from that, I would say they are, these businesses are there across sectors. But I don't think we see too many examples of family run businesses when it comes to hardcore technology or hardcore SaaS. Most of these companies are typically started by first generation founders and have raised money from global or local VCs.
Now, a little bit about the competition. When we take young people, folks in 20s, 30s, 40s, first of all, how entrepreneurial are people, risk averse? And number two, are they more towards going into SaaS and technology versus going into this boring, messy manufacturing companies? When it comes to founding and building, not joining as an employee.
Sure. When it comes to founding and building, see, most new founders, I'm seeing today, want to build companies in relatively more traditional sectors. Till say about 2 years back, before so to say the markets kind of crashed, I would have seen, more interest towards building, technology companies. So while there are pockets within the technology industry that are very, very exciting and attractive right now, for instance, AI, for instance, EV and space, these are areas that are very, very exciting, for the new age of entrepreneurship that we are seeing here in our country. But I would say the interest is a lot more towards traditional sectors than, say, any time in the last 10 years or so. So, that's a big change. I would have never anticipated it, but it's also been a function of, what the venture or private equity markets are open to right now and what they are rewarding right now, which is, traditional enduring businesses rather than, so to say, technology businesses, which will probably give you a 100x or a zero kind of an outcome.
And what are the you seeing at the moment? What are the biggest risks and challenges faced by those family-backed, family-owned traditional businesses at the moment? Is it the competition? Is it something else?
See, I mean, I would say that for most family run businesses in India, the biggest challenges are internal rather than external. And, that's been my experience in advising them, over the last decade or so. So, families that have probably taken, so to say, the initiative to sort governance issues out, in form of that to begin with, do I have a shareholders agreement in the first place? Do I have, so to say, planning in terms of, how do family members come into the business? How do family members go out of the business? What is my hiring policy regarding hiring from the family or not hiring from the family? If somebody does not want to be a part of the business, right? How do I take care of them? How do I bring in external professionals into the company and at the same time, give them the compensation, respect, and the autonomy that is desired for to take my company, to the next level. So anybody who's got a formalized governance charter in place are the businesses, in my opinion, who have a head start against those that have kind of, let some of these problems or open issues fester.
You mentioned before a little bit about the key man risk, the owner being very involved in everything. So when he doesn't wake up in the morning, it's there's a big trouble. So how are those traditional family-owned businesses adapting the so-called digital transformation and innovation, and or is it everything still on the papers, or they're using a CRM, or how is it?
So see, when it comes to adoption of technology, I think, especially in the last 10 years, Indian family-run businesses have done a rather low-key but very, very good job. So unlike, so to say, venture-backed companies, they won't have, so to say, an army of technical staff. But when it comes to using technology, right, as, so to say, a tool of driving efficiency and as a tool of driving business intelligence, they've done as good a job. So I'll give you two examples. The largest non-banking finance company in India is called Bajaj Finance, which is again a family-run business, right? They'll have a market cap of, I'd say, more than $100 billion today. Now, their technology stack in terms of underwriting, in terms of customer acquisition, would almost be just as good as any, so to say, fintech startup in the country. The largest paints company in India, again, a company that's worth a few tens of billions of dollars, right, is called Asian Paints. Their, so to say, supply chain ensures that, the hundreds of thousands of dealerships or, so to say, that they have around the country are, so to say, fulfilled just in time. So, their technology will not hit you in the eye. It will not be particularly flashy. It won't give you an aha moment. But does it do a phenomenal job of making sure that the business has a competitive advantage in terms of efficiency in supply chain? I would say an overwhelmingly yes.
Now, a little bit about the success stories, and maybe you have some you've worked with or you've seen. So, can you maybe share some of the uh, so-called success stories of those traditional family businesses you worked with, for example?
No, absolutely. So, one of the recent companies that we just advised, on a fundraise, is a company that's among the largest, I'd say, contract manufacturing companies for global fast-moving consumer goods companies in India. So, they would manufacture everything, from biscuits to, other consumer products for large global companies like a Unilever, like a Mondelez, like an ITC, the works. The company is more than 2 decades old, right? First generation was spent mostly in building up a minimum critical scale, building up a track record with their customers. And when the second generation took over is when the business actually flew. Over its 20-year history, the company would have probably grown the fastest despite being at its highest scale ever in the last 4 years. And we ended up raising $100 million for them, and every large or respected private equity fund globally was interested in cutting a check for this particular company, right? A traditional family owned manufacturing business, which was considered gold standard not just in India but globally when it comes to their competence. And the bedrock of doing this was, manufacturing practices that had been refined over the last 2 decades, trust which had been built, with suppliers over 2 decades, trust which had been built with customers over 2 decades. And this is a job that, I dare say, a business which was not family owned would have, struggled to put together.
So, when you looking at the future of those traditional family-owned businesses, what are your thoughts or expectations, or maybe on the negative side, some of the fears they may be facing?
The fear would be along when it comes to family-run businesses, would be along 2 or 3 different dimensions. You know, the first, especially when they go out to raise financing, is their potential relationship with the partners that they're getting on board, right? So if I'm getting a private equity investor on board, obviously on paper, given that as a private equity fund, you're managing other people's money, you want certain rights and privileges. Now, am I open to, giving them the kind of rights and privileges that they want to be able to do their job well? Number two, given that some of the relationships that they've traditionally had have run over years and decades, finding comfort and trust, right, is one challenge. B, being open to good quality external advice, when it comes to your own business transformation, getting new business practices, getting new employees as you kind of professionalize your company. Are, I think, some of the challenges that family run businesses face. Now, the good thing, Mick, is that in the last 3 or 4 decades, we've had enough and more large success stories to demonstrate the outcome. For instance, some of the largest family-run businesses in this country, whether it be a Pidilite, whether it be a Marico, whether it be Asian Paints, which operate in very, very traditional sectors, have done a phenomenal job around 2 or 3 different dimensions. The first dimension is making sure that I am getting professionals to run the business for me, people who are doing a much better job than what I would have done. Number two, giving them an operational autonomy, not just on paper but in spirit. That, listen, I may be chairman of the board, but I will not overrule the decision of the CEO, right? I am here to give him a free or her a free hand. Number two, making sure that I do a very, very good job in terms of wealth creation for people outside the family who are building the business for me. So having a very, very generous ESOP policy, for instance, right? And it works like magic because, some of these companies, if they have the right intent, if, they've done a good job in compensating their workforce by giving them ESOPs, the returns for their employees have been a lot more predictable than what they have been in startups. And Mick, these companies have been extremely handsomely rewarded by the capital markets. So some of these companies over the last, I'd say, 10, 15, 20 years have been trading at a price to earning multiples of anywhere between 50 to 100, right? Which is, well, outrageous, but that's where their valuation has stayed for the longest period of time. Now, not because they are very high quality businesses, but also the fact that the owners have very high skin in the game. So for a traditional family owned businesses that is listed on the stock exchanges in India, their shareholding would be anywhere between 50 to 60%, right? That's very high as compared to, say, businesses that have been founded by first generation founders, where they'll have anywhere between 5% to 20% in the company. So given that a lot of their wealth is still married to the company, gives the smaller shareholders a lot of comfort while they're investing in these companies. And number two, if you've done a very good job in terms of corporate governance, right, in, so to say, an emerging market like India, it comes with its own premium. So if for the last 20 years that I've shown you that my books are absolutely clean, I've been very transparent in terms of communicating to the market whether my business is doing well, or especially when it's not doing well, right? Giving the right guidance that, listen, last year was great, I grew by 20%, but this year is not looking good. I'm going to only grow by 5% this year. Or I'm investing in new initiatives, so my profit margins are going to go down by 10%. If I've got enough skin in the game, and if I'm doing a good enough job in terms of transparency and governance, well, I mean, the kind of the way in which the market rewards you is really unprecedented, especially so in a developing market like India than, say, a developed market where a lot of these corporate governance standards are pretty much taken for granted.
What is your message for investors who would like to maybe diversify their portfolio and they're like, okay, India seems very interesting. I would like to invest on a private market in India. What would be your message for them when maybe looking at those traditional Indian businesses? That's number one. And number two, how easy or hard it is for them to invest while living in US, living in London, living in Estonia?
So, given whatever I've seen or learned, make over the last 1.5 decades of being in this business, my first advice would be, don't be a tourist investor. Come here, spend time, meet enough people, try and be an insider, make relationships. So, that would be the ideal long term way to build business. Now, as an asset allocator, many a times I won't be able to do this because I've got 20 other priorities, right? I mean, I've got markets which are probably more important for me. In that case, I would say when it comes to investing in private markets in India, the best approach is, either invest in local funds that have had a great track record of investing in the country over the last 10 years, or, start with co-investing alongside some of these investors, right? Because I think many investors, when they're coming to India for the first time, the mistake that they make is try and draw parallels from the US market or the China market and see, if there's a similar story they can back here in India. But, I mean, in that regard, India is not really for beginners. I would advise best way to approach the India market when you're cutting your first few private checks is be in the company of those with a track record. I mean, if a well-known private equity fund in India with boots on ground is investing $100 million in the company, why don't you start investing by $10 million alongside that and try and learn the markets as you go along, till you build your own track record, till you build your own knowledge about the markets at large. And there are enough and more such credible people here in India. Such funds would run into dozens in numbers.
We had a short chit chat before this recording, and you said that now, when it comes to US market, you said the US the market here is heavily skewed toward growth financing and IPO of these businesses rather than roll-ups. The market still rewards growth more than efficiency, given the multiples, which are 2.5 to 3 times in US and China. So, what are your thoughts? Can you explain more about this?
I think to some extent, it has to be with the history of how financing has evolved in India, right? So, I mean, the US has had controlled transactions, private equity, probably for the last 4 odd decades or so, since the early 80s. Um, Whereas in India, I would say institutional equity capital for the private markets is probably about 2 decades old. The second difference is that India is a high growth economy. So, I would say a mid sized listed company in India would probably grow anywhere between, 10 to 15%, because our GDP growth is close to 7%, which means if I add inflation, our nominal GDP growth would be anywhere between 12% to 13%. So any company by default would probably grow at that pace, which is probably 2 to 3 times the pace of growth of a company in the US. When it comes to listed startups, we're probably talking about anywhere between 20 to 30% growth year on year. Uh, and this kind of reflects in your market multiples as well. Uh, a good, well run public company which is growing in India would probably be listed at anywhere between 30 to 50 times EV to EBITDA multiple. Now, let's say if I'm a private equity investor, I want to do a control transaction, right? Uh, I would probably give you what? 10, 12, 15 times EV EBITDA multiple. Even that sounds very, very rich. Now, I'm a business owner. The choice that I have is either I sell my company to you for 10 to 15 times EBITDA, or I can just sell 1/3 of my company in the public markets and I'll make an equal amount of money and I'll still have 2/3 of my company. So, that's where the arbitrage is, and which is the reason why, more business owners in India would probably, gravitate towards growth financing outcome and eventually listing rather than, a control transaction where, they're selling their entire company. Unless, of course, I'm running a company which is probably growing anywhere between, 5 to 10% year on year. In that case, I'll probably look to harvest value and, simply sell.
I didn't ask before, but I want to still ask. When working with those businesses, do those traditional companies prefer to grow organically, or they look for ways to grow through using M&A usually?
I would say, traditional family businesses in India have been a lot more conservative when it comes to M&A. While I can cite dozens of examples of M&As actually happening, but I think typically the lens through which they look at M&A is very, very conservative. And I've seen the bid-ask spread is typically very, very high when a family-run business tries to, acquire, so to say, a complementary company or a competitor, as compared to, I would say companies that are run by private equity or run by founders which are backed by venture capital, who are, I'd say, a lot more aggressive and open, to M&A as compared to traditional family-run businesses.
I know this interview is going from A to C very fast. Now, how can Indian businesses better position themselves to attract those outside investors who would maybe like to invest in their company, so they could grow in India? Because again, India is a very attractive market.
I would say, as a family-run business, it's very, very important to have a plan in place. You probably need to start. You need to start preparing for an external financing, probably 3 or 4 years ahead of an actual financing event. Making sure that your holding structure, your governance structure is in place. B, operate in a white space which can give a disproportionate return to the incoming investor, right? So, if I'm a consumer company, am I thinking deeply enough about my competitive advantages, right? Distribution, brand, product strategy. Do I have them formalized very, very well? Do I have the ability to articulate it very, very well, as just as well as say first generation founders? So this entire process of preparation would make probably end up taking 2 to 3 years time. So a being at peace with the fact that, listen, I mean, external financing brings me certain benefits in terms of both tangible value addition as well as value harvesting opportunities later on. And, to make the best of this opportunity, I need to go in with certain amount of preparation. And being conscious of it, I would say, is very, very important. But as on today, I think most of our mid to large sized family run businesses are doing a good enough job in terms of attracting enough and more interest from large global private equity investors.
I want this last part of this call. I want to talk about you and your maybe personal insights and recommendations. I'm looking at the Rainmaker Group website, and under the transactions, there are a lot of deals you've been consulting. So when it comes to your success and the success of the Rainmakers Group, what have you learned over the years, and what are maybe some of the non-obvious things you maybe done to make sure that you've been growing and you've been able to do such large transactions and building the business as big as it is today?
I think the biggest learning that we've had is that focus on fundamentals always helps. And I think trust is the biggest currency, when it comes to the business of advice, right? Because when you're advising, founders who themselves are a very, very evolved species, right? I mean, all of them have built something very, very substantial. Many of them have built businesses that are valued into billions of dollars. I think, making sure that you win their trust and retain their trust is the most important currency in the business, right? When sometimes you end up making mistakes while you're trying to deliver the best for them, they will live with. But a breach of trust is something that can never be repaired. So, as long as you're trustworthy and as long as you're sincere, I would say that's the biggest asset in the advisory business.
How has entrepreneurship and building the Rainmaker Group changed your life and changed your family life?
My family life has certainly not improved, is what what I would say. I think where it's probably helped me is that it's given me a sense of purpose that I probably never had in life before.
Awesome. So let's wrap up with famous five. How old are you?
I'm 44 years old.
Favorite book?
My favorite business book is Barbarians at the Gate. I mean, it's an absolute classic. In business schools the world over, it's used to teach everything right from business ethics to M&A to private equity, and it's a book that I would have read half a dozen times over. So it's a business book that I recommend to everybody in the team.
Married, single, kids?
Married for the last 16 years, and I have one 12-year-old child, a boy.
What car do you drive?
So in India, one luxury that you have is you don't have to drive your car. You can obviously get driver to drive it for you. But yeah, I mean, in terms of my taste in automobiles, I'm very, very low key. I prefer an Audi and a Toyota.
What's the best investment advice you've ever got?
The best investment advice that I've ever got is, just put all your money in Indian equities, because, the last 10 years have been very, very rewarding, and, the next 10 years would be more rewarding.
Last one. Where can people find you?
Well, people can find me pretty much anywhere, on my Twitter handle, on my website. And when it comes to physically, I think mostly in the office.
Okay. That's it, Kashyap. I really enjoyed talking to you. Indian market, very interesting. I've been there as a tourist, but doing business, I can see why you're excited and why you're doing what you're doing. So thanks a lot for coming to the Holdco Builders podcast.
Mick, thank you for being a great host. Appreciate you having me on the podcast. All the best, and look forward to hosting you in India soon again.